Hey, let's bring in now Osaic, their chief market strategist, Phil Blancato. Phil, this is the Goldman Sachs panic index. So it's crazy, right? I mean, a whole lot of panic. Actually, we've been spiking here since last summer. What do you make of it?
That's what happens in a concentrated market. When the market gets very narrow and 7 stocks dominate total return, you get these high vol situations.
When those stocks start to get wobbly.
That's exactly right. You're getting the Mag 7 be less magnificent, specifically NVIDIA, even though I thought the numbers were great. But you look at it, and that's what's causing this. And the fact of the matter is, to your point, headlines can be worrisome. Now, the market's incredibly good at climbing the wall of worry, except for this. You have it highlighted right there.
You have been telling people, hey, listen, lighten up on the Mag 7. Yep. And listen, certainly in February, that was the right advice. I mean, they're falling off a cliff. Here's my observation, though. When does this number, when does the rest of the market sort of make up for the Mag 7? Because although the rest of the market hasn't collapsed, it's not making up. Like, it feels like to that point, right? Yeah, you panic because the market's down, and it doesn't feel like the market can withstand much pressure with the Mag 7.
Think of it this way, a 9% drop in the Mag 7, you have to have a 20% lift off in the other 493 to be flat.
Right.
So what's happening now is you're having a bit of a rotation. And the reality is earnings season was good. We continue to see really strong earnings numbers. What does it tell you? You can go to other places in the market and diversify, take some profits and pivot, and you'll be just fine.
So you've been talking also. So right here, right, beginning of the year, felt like, okay, we're going to go back and test this 5%, right? I mean, everyone was a little bit nervous about the bond yields. Bond yields have come down fast. Maybe some say too fast.
A little too quickly.
A little too quickly. Yep. But you've been positioning yourself in bonds. But what is it about the velocity of this pullback that doesn't make this necessarily news that we break out the pom-poms?
Well, the reason why I like the bond market's free lunch. I'm getting a 4.5% yield, and I got a chance for, as interest rates go down, to make money. But the velocity here is clearly simple. This is where the headlines ended up. This is where the fear situation falls in. When people get nervous, it is a flight to safety. Why? Tariffs, Russia, Ukraine, uncertainty about Doge. This is where people pile into when that happens. By the way, that's more retail than it is institutional.
This right here.
Yeah.
What about on the money markets? I didn't look this weekend. Did anything change there significantly?
No, you still have a significant holdings there. Why? Because you're getting 4.5% for just hanging around. 4 3/4, 4 1/4, depending on which type you're in. But the incredibleness of you can just have this free lunch in cash, or even I would argue longer duration bonds, because you can get both.
Coming into the year, there was a lot of consensus around the idea that at some point this year we get back around 3.5, 3.6. Is that back on the table?
I think the long-term natural rate, what the real rate is when you don't spur lending or take away from lending, is 3.75 on a 10-year. That's not today.
But we can live with that.
We can live with that. We're just not there. That's 18 months from now. Why? The consumer's too strong.
All right, let me speak about the consumer for a moment, because Friday we learned that personal income up 0.9%. Look on this chart, folks. That's pretty impressive. That's hugely impressive. Spending, though, spending came down 0.2%. Savings went up. Obviously, people are worried and afraid, but is there more to it than that?
Yeah, we had a real winter. It was cold in January. The East Coast froze over. We haven't had that in a long time. The Great Lakes were frozen. So that.
But what about internet? People still didn't really.
It does, but you got to remember you spent $1 trillion in the fourth quarter of last year. You need some capitulation. So January gave us that opportunity.
That's a lot of capitulation.
It is, but let's not forget, when every time gasoline falls, guess what? Every 10-cent drop in gasoline is $50 billion in the consumer pocket. What's the consumer done? Made a bunch more money by spending less on gas. You're seeing some of that in there as well.
Okay, so
by the way, that's dry powder.
Okay, so you point to this. This was huge, the consumer spending. It obviously went down. You're looking for some sort of a bounce back here?
Remember, Easter's late, Passover's late. You're going to get a really strong bounce back going into the spring season because of those late holidays.
All right, let's talk
Don't be afraid of the U.S. consumer. I keep pounding on this. Consumer's still quite strong.
Okay, all right. I'm just looking at delinquency rates and things like that. But as long as someone's spending, okay, even if it's just 3 people and they keep the thing going, that's fine. Let's talk about some of your ideas, because Palomar, I haven't heard you mention before.
This is an interesting name, you know, at a time when there's so much stuff around hurricanes and fires and floods. They benefit by being the insurer of last resort. So you're looking at 50% earnings growth. You got a company that crushed it last year at a time when people in certain parts of the country need catastrophic insurance. Right. They're providing it, and they're high double-digit earnings growth.
That was the hot spot last week, insurance companies in general. Dropbox.
You know, I like this idea of the AI trade outside of the companies that have already made incredible returns. They're an old name, right? But they're now partnering with NVIDIA to offer an AI solution inside of Dropbox. You're looking at 11 to 15% earnings growth. Steady Eddie will do really well with this ongoing euphoria around the residual effect of AI. That's where your opportunity is.
So I'm reading Urban Outfitters. I mean, maybe 15 years ago, my son was in the first year of high school. He said, buy Urban Outfitters, and I did it. It went straight up. I didn't know it was cool again.
It is cool. Well, they own a few different brands. You know why I like it? Here's what it comes down to, folks. When you look at the folks who make less than $100,000 a year, they've had an average wage increase above the rate of inflation for nearly 2 years. That's where they're going to spend money. You look at a company's margin, by the way, closing in on 11% for a clothing manufacturer. Right. That's incredible. That's where you want to make your bet. It's a safe bet on the U.S. consumer that's doing okay.
Well, and plus they sell albums for mom and dad while the kids are shopping. You're smart. All right, thanks a lot, Phil. Talk to you again.